participating in Lexi's webinar today. My name is Frank Krafka. I'm the eDiscovery Solutions Director for the Northeast Territory with Lexi, and I'll be your moderator for today's event. Before we get started, I've got a few housekeeping rules. You've been placed in listen-only mode to prevent background noise from interfering with the presenters. In the event that you have an issue, please email us at webinars@lexi.com, and we'll address the issue right away. If you have a question, please enter it in the Q&A portion of the web conference interface, and we will follow up with you after the webinar. I'd like to start with a little background information. Lexi is an 11-year-old cloud-based provider of DIY e-discovery processing and document review software. We're based in Austin, Texas, and we offer one of the industry's fastest ESI document processing and data conversion services and handle a vast range of file types, including Macintosh files, Office 365, SharePoint, social media, all media types, and we also provide language translation services. The webinar today is titled Litigation Finance, Best Practices and Emerging Opportunities. We are joined by Sarah Lieber of Buford Capital. Ms. Lieber is the Vice President of Buford's Underwriting and Investment Arm, with a particular focus on originating investments and providing strategic guidance to leading law firms and global corporations on deploying Buford Capitals in ways that address their litigation and financial needs. To help provide some context for Sarah into what the audience is generally looking for from the webinar, we would like to ask you for feedback with a few quick polling questions. First question, how does e-discovery affect your litigation budget for most cases? Okay, I'll close that poll. For the next question, are you considering litigation finance for a current or potential case? All right, we have a few more answers coming in. Okay, we'll wrap this up. Thank you for your participation. And with that, I'll hand the presentation over to Sarah Lieber.
I'm Sarah Lieber, and I'm with Buford Capital. We are the world's largest specialty finance provider focused on law. I'm going to talk today about specialty legal finance, also referred to as litigation finance or litigation funding. Internationally, you might have heard it referred to as third-party funding. And for ease of reference, I'll just call it, for the most part, litigation finance. Obviously, litigation finance has become a hot topic and media darling in recent years. You've likely read that what was once a fledgling concept in the U.S. about a decade ago is now a multi-billion-dollar industry. And the prevalence of the use of litigation finance is really the result of need, both the corporate client's needs and the law firm's needs. It should come as no surprise that legal costs are rising and have become, in many instances, prohibitive for clients. This has reduced clients' ability or, frankly, willingness to pursue or defend claims often of strategic business importance for the corporation. And from the law firm's perspective, law firms can't always meet their clients' needs for alternative funding. Repeatedly providing reductions to the hourly rate is, frankly, a killer for law firm profitability. And it's limited the firm's options to meet their own capital needs and for the firm's operations and growth. So that's where the specialty legal finance provider like Buford Capital comes in. If you take only a few things away from today's discussion, I hope they're the following. First, litigation finance is used by CFOs and GCs, the corporate client, as well as by law firms. At Buford Capital, we've financed everyone from FTSE 10 companies and startup companies to 75% of the AmLaw 100 and most of the Magic and Silver Circle firms. Second, it's used on single cases or against pools of cases. It's used by plaintiffs and it's used by defendants. The litigation financier can get involved at any stage of a litigation, before pleadings to even after settlement, or even in relation to monetization of fee receivables. And finally, it's expanded beyond merely paying legal fees and costs to get the case from point A to point B. Clients have accessed litigation or legal finance for operating capital, to pay partnership distributions, to grow a practice area, to monetize a judgment or a settlement, and even in non-litigation contexts like M&A engagements in private equity deals where the underlying asset has a litigation or regulatory encumbrance. So it's really capital provided by a specialty finance provider where the value of the litigation claim is used as the underlying asset. This is capital that is non-recourse, and it's provided in exchange for returns tied to a case outcome. By non-recourse, I mean that unless the claim or defense, if it's defense funding, is successful, the financier does not get paid its investment in return. Burford Capital, as I mentioned, is the largest provider of litigation or legal finance in the world. We are a publicly traded company. We're publicly traded on the London Stock Exchange and have a $2 billion market cap. Since our inception about 8 years ago, we've committed more than $2 billion to legal risk, and we've, again, financed firms and clients. Our minimum investment is usually in the $1 to $2 million range, but we've provided up to $100 million in financing in a single transaction. We're able to do this because we are a team made of experienced veterans from the top law firms. We've all essentially grown up in the AmLaw 100 or Magic Circle firms. We come from banks and corporations, and all of our diligence is done in-house. Why that's important from a client's perspective is because instead of having your litigation financier not understand your case, not being able to appropriately value the risks associated with your matter, or turning the underwriting over to one of your competitors, and that competitor is then potentially introduced to your client and introduced to your matter, Burford Capital will diligence it all in-house and can understand your case and get to the core of your financing needs quickly and flexibly. That's really made us the leader in new financing products. So let's talk about how corporate clients are using legal finance and what the benefits are. And then we could talk about how law firm clients are using legal finance, what the benefits are for them. This has really been a fast-changing industry that's responding as quickly to clients' needs as the clients' needs themselves are changing. So how are corporate clients using our capital? There's the traditional way that most people think about it, where Burford or a litigation finance provider will step in and pay the legal fees and expenses for a client who simply can't afford their legal fees. Or where you have a corporate client that wants a steep reduction in a firm's hourly rate or a contingency relationship that the firm's simply unwilling or unable to do, Burford can come in and allow that corporate client to hire its firm of choice and get the engagement that it really needs by creating a synthetic contingency relationship for the client. Corporate clients are using litigation finance to monetize their litigation assets and receivables, to finance, sell, or collect uncollected judgments. Oftentimes, you'll find clients that have fee fatigue and want to share risk on a matter. There's nothing more frustrating, frankly, to clients that have gone through trial and have won or have reached close to resolution on their matter, and now they face the prospect of a prolonged appeal. To them, that's just intolerable, and just the thought of putting out millions and millions more dollars to get it to the final resolution is just not possible, or they just can't bear it anymore. So we'll come in and share risk on appeals with those clients. And more often, corporate clients are simply using litigation finance as an accounting tool to remove legal spend off balance sheet, which we'll talk about in a minute. To access operating capital without adding to the corporate debt, we've worked with corporations and their regulators to craft solutions, giving them non-recourse capital to be used as operating capital, for example, where there's simply no room for debt on the corporate balance sheet, and so accessing the traditional capital markets just wasn't an option. So that's another way that corporate clients are using litigation finance. I think the benefits to corporate clients are fairly straightforward. Obviously, legal finance has an obvious and immediate financial benefit to the client. It can unlock value tied up in unresolved litigation. It alleviates the legal department's budget and pressure, uncertainty in quarterly and annual spend. Depending on how the deal is structured, the GC or the CFO can know at any given time exactly how much its legal department will spend in a quarter and can budget accordingly. And again, it allows the pursuit of important claims without adding costs and risk to the corporate balance sheet. So for a corporate GC or CFO, the calculus isn't necessarily, can I afford the $1 million or the $10 million in legal spend to get my cases to resolution? It's, can I afford it right now, given the effects on the balance sheet? Corporate clients, obviously, are also now using litigation finance as a risk management tool. Litigation is unpredictable and risky. GCs clearly struggle to justify spending, and that trickles down to their law firms and adds increasing pressure for reduced fees. And offloading that risk onto the litigation financier's balance sheet has really become, for many GCs, part of a proactive and prudent risk management program. We often talk about how litigation finance has become a tool of choice and not need. And that is in part because of the positive accounting benefits of financing legal spend as opposed to paying cash out of pocket. When legal expenses are paid with cash, they flow through the corporate P&L. They're recorded as expenses and they reduce profits. Even worse, assume you have a plaintiff's case, recoveries, when you've been successful, are recorded below the line as non-recurring items. So the net effect of your successful litigation campaign when you're a GC oftentimes is a permanent reduction in the corporate EBITDA. That's not great, and it's especially painful for public companies trading at a multiple of earnings. $10 million of legal spend for a company trading at 20 times earnings could be $200 million loss on the corporate balance sheet. So again, the CFO and the GC are having a conversation not about, do I have the $10 million to pursue this litigation campaign or pay these legal costs or hire this firm? It's, can I afford $200 million in loss on my balance sheet at this point in time? Litigation finance removes the costs off balance sheet with no reduction to the EBITDA profit, so it's obviously become a very attractive tool for corporate clients. Finally, it's always helpful to have legal strategy validated by experts. When I was in-house, part of what we did was hire outside counsel as a gut check. Is this something that we should pursue? Does outside counsel agree with the strategy? An experienced litigation finance partner like Burford looks at billions and billions of dollars in commercial litigation. We see more of any one type of litigation than any single firm out there because of the volume of matters that come to us. So the funder really can act as a sounding board for the client. And frankly, when your matter's been vetted by layers of investment committees, chosen to provide millions in non-recourse investment against your case, that acts as an independent endorsement by an objective third party. Tactically, it reaffirms the strength of the client's position both internally and should it ever be disclosed, it's often not disclosed that cases are fines, but should it be disclosed, tactically it reaffirms the strength of your position to your opposition. So now let's turn to how law firms use litigation finance. Firms are accessing non-recourse capital, again, to take matters on where the client needs or wants a contingency or steep hourly reduction and the law firm just can't provide it. And we'll create a synthetic contingency for the client or bring the firm closer to their traditional hourly rate. Where the firm is comfortable taking risk, but not as much risk as the client wants, the litigation finance provider can share that risk. And where the firm is on risk on a pool of matters and wants to offload some of that, whether to monetize a portion of their receivable or expand their ability to take on additional risk, the litigation finance provider can come in and share some of that risk. Firms are also using our capital for operating capital, growth capital, for partnership distributions, to build out office space, to grow into a new region, or to pursue a certain line of future engagements by practice area or for the firm. I mentioned monetizing receivables. Firms often access non-recourse capital at the end of a quarter, before books are closed, to bring in hourly receivables as well. So it's being used by law firms in many, many different ways. The benefits, again, are fairly obvious. Most firms are just not built to sustain all that much risk. They're comfortable with the hourly model, but they're under increasing pressure to provide clients with options. And so they've got to become more creative than just reducing hourly rates. Again, that just doesn't work for the firm's bottom line. So being able to provide contingency or alternative fee arrangements for their clients backed by non-recourse capital where they're sharing the risk has become a real growth tool for the largest firms in this country. Allowing the firm to grow in a manner that provides clients with what they need but still maintains the risk profile is key. And again, this is all on a non-recourse basis. So how does litigation finance work? Let's talk about single case financing, which is what most people think of when they think of litigation funding. That's the traditional model that I think most people have heard of In reality, it's only 13% of our business. Our business has evolved towards portfolio funding or specialty and complex funding. But 13% of our business does still remain single case funding. And oftentimes that's a way for firms and clients to start the process or get comfortable with litigation finance before branching into other things. So Burford Capital can come in at any stage of litigation to finance single matters. We can come in before the pleadings have been filed. We can come in once discovery is hit and you realize the case is more expensive than you anticipated. We can come in again to de-risk appeals where a client has fee fatigue, or once there's a settlement or a verdict and either the client or the firm want to take some money off the table and lock in value today. It's traditionally used in business-to-business disputes. These are large commercial matters. It could be fraud, securities, construction, international arbitration, any other type of dispute. But again, our minimum investment is typically $1.5 to $2 million. So there really needs to be enough of a spread between the amount of the investment and the amount of reasonably anticipated receivable or recovery on a matter. We always want to make sure that there's enough room in the recovery so that the client primarily comes out ahead of everybody, the law firm gets its fair share, and there's enough room for our return. And we won't ever enter into a transaction where we think that on the high end, if this case is incredibly successful, everyone will be fine. But on the low end, it's going to be too tight and somebody's going to come out way which is not positive, and we won't ever take on those deals. And again, because our capital is non-recourse, and as we'll discuss in a bit, because this is passive investing and that we don't control the litigation, we can't control settlement, we'll only invest in the most meritorious of claims that warrant financing. We are incredibly disciplined, and we turn down a good majority of the matters that are brought to us, and I think most litigation financiers are the same. So that's single case funding. More common than the single case funding, frankly, is portfolio financing, where a firm or the client pools together groups of cases, and these can be diversified, multiple disciplines, cross jurisdictions, or it can be cases within the same type of matter for a similar client. And it could be as few as 2 cases or as many as every contingency case at a firm. And they're pooled together and capital is provided against the pool. And what this does is it diversifies our risk, it lowers pricing for the client, and it permits incredible flexibility in the use of the money. So again, what the firm or the client is able to access is not merely the amount that it would take to bring these cases from point A to point B, from pleadings to resolution. We are ultimately looking at the underlying litigation as an asset against which capital is being received. And if the receivable is large enough, you can access capital beyond just fees and expenses. So it can be used in many different ways, for operating capital, for growth capital, as you will. And the flexibility that's permitted in a portfolio allows a client to shift resources as the case needs. You have more experts in one case than you anticipated. Discovery is taking longer in another case. You're now gearing up for trial in the third case. The funds can be shifted to the cases in a very, very flexible manner. There's also something called an open portfolio, in which we'll make capital available for future cases based on the criteria of cases that can go into the portfolio. So essentially what this allows the law firm to do is go out and pitch in a way that maybe it otherwise could not. If a firm has ever found itself in a situation where it's going into a pitch and it just knows it's not going to get this engagement because its competitor is going to be able to give an alternative fee engagement that this firm just won't do, now it has an option that it didn't previously have because it's already essentially pre-de-risked those cases before going into a pitch. And it knows, based on the criteria that's been set for this portfolio, that that case will go into the pool and it can access capital from that portfolio. We've talked before about defense funding, and defense funding is certainly less common than plaintiff's case funding, but it's done fairly often. It can be done on a single case basis, or it can be done in a portfolio. Single case is usually reserved for pretty special circumstances where the client, for whatever reason, wants to get litigation spend off balance sheet, or it wants certainty in the defense budget. And usually the way that works is the law firm will take the case on a reduction of the hourly rate, define success If you get me out for $20 million or less, the firm will be bumped up to 100% of its hourlies. If you get me out for $5 million or a motion to dismiss, the firm will get a success fee, usually corresponding to the percentage of reduction in the hourly that originally granted. So let's say I'll get a success fee of 40% of my hourlies. What the litigation financier can do is de-risk that for the firm. So bring the firm closer to its traditional hourlies and share in a portion of the success. More often it's used on a portfolio basis, and our Grant Thornton case study at the end of this deck highlights the use of portfolio finance for defense and other matters. In a defense context, which is a very attractive model for corporate GCs and CFOs, valuable plaintiffs' litigation on the docket is used to access capital, which can be used for both those plaintiffs' cases and for the defense cases or for any other reason. So essentially, you're leveraging the plaintiff's recoveries that you anticipate to pay for financing that's going to cover the entirety of your legal docket. And that, again, can help a corporate GC eliminate all of its legal spend off balance sheet and have the concurrent increase in profitability on the balance sheet and reduction in loss. Litigation funding doesn't only have to be non-recourse. You can access a recourse line of credit for working capital. And there's also asset recovery. We also have an asset recovery business, which is helpful both for our own internal underwriting process as well as for corporate clients or law firm clients who want to chase assets and force judgments on a contingent basis. We found that to be incredibly useful and an incredibly attractive option for our clients. It's also being used beyond litigation, as I mentioned before, on law firm M&A engagements, for example. Wherever there is a risk-based relationships, and often now firms are taking on M&A engagements on a success fee basis, the corporate client wants the firm to be on risk, and you won't get paid unless this deal closes. But when the deal does close, you'll get a success fee. We can help firms de-risk that relationship as well. It's being used in private equity transactions where the underlying target company either has a litigation encumbrance or has a need to clean up its balance sheet. We can come in and help fund litigation and bring money to close, for example, to bridge the gap between the target company and the private equity firm that's valuing that underlying litigation at exactly $0. But the specialty finance provider can come in and take a look and say, actually, that's a $50 million dispute or $100 million dispute, and you can access, tens of millions of dollars in capital against it. So what will your relationship with litigation funder look like? I mentioned before that litigation financing is passive investing. There's no interference with the lawyer-client relationship. The funder does not control litigation strategy or settlement. All of the underwriting is done before investment. So Burford will take a very close look at the merits, the parties, the jurisdiction, the damages, the enforcement issues, and make a determination about whether or not this case or group of cases fits within its investment criteria. And they'll look at it pretty closely before they invest because, again, the litigation finance provider is passive provider of capital, can't control strategy, can't control settlement. So it's incredibly important to get it right because if the case does not work out, and occasionally that happens, and that's the risk of this business, litigation finance provider won't receive a return on its investment. In the diligence process and throughout the course of the investment, the financier is going to ask for confidential and attorney work product information. The case law uniformly across the country has confirmed that work product protection applies to the funder and to the documents that it receives from a client. We will rarely ask for attorney-client privileged information. We just don't need it, and so we're very careful about doing that. Once invested, of course, there are reporting requirements so that the litigation financier can, so to speak, keep in the loop on its investment. So similar to the way you would report to an insurer, the litigation financier will get reports on how the case is doing, what the strategy is. It might see briefs before the briefs go in. But again, ultimately, the control of the litigation is the clients and the attorneys. Our investment process is pretty simple. Usually it starts with a phone call, very high level. This is the need, this is the challenge that we're facing, how can we craft the solution. We will enter into an NDA to make sure that we are within the scope of the attorney work product protections. We'll review some background information, we'll probably look at the pleadings, we'll take a look at damages, we'll have a discussion with the attorneys, and we'll do a deep dive into the diligence and the merits, the economics of the investment. Ultimately, that culminates in a term sheet. It'll go through a few layers of investment committee review, and following a final approval by the investment committee and definitive deal documents, we will invest. And again, following investment, there'll be reporting requirements to keep us in the loop of the investment. I have here 3 different case studies highlighting the different types of investments that can be done. The first, the FTSE 20 company, is an example of a portfolio used for balance sheet planning. Here you have a FTSE 20 company, obviously very wealthy, can well afford its litigation, which utilized $45 million against a portfolio of cases to essentially shift their fees and expenses off balance sheet. Those funds, again, can be used flexibly for whatever corporate purpose the client needs it to, and it's non-recourse. The next case study is the Grant Thornton insolvency portfolio. And here you can see this is a pretty natural extension of litigation finance, where you have single case financing extending ultimately or evolving into portfolio financing. And so you can see how in the insolvency context that makes a lot of sense. You have trustees, you have debtors, you have creditors who want to get paid out, and there's not a lot of money to be had within the scope of the estate. So portfolio financing has been used by insolvency trustees in a lot of different ways. And in this case study, we see it being used by Grant Thornton acting as trustee to fund a bunch of different needs, declaratory judgment matters. Those don't typically warrant litigation funding because there's no capital coming back in at the end. But here you can use the funds for the plaintiff's cases within the portfolio, defense costs, declaratory matters, administrative costs, whatever you will. And this has been a very successful model for insolvency trustees. Finally, we have the Rurelec case, which is a hybrid solution used by a company for operating capital. You have an entity in Bolivia whose facilities and assets were expropriated, and they really just could not access traditional capital markets at a rate that made any sense whatsoever. So we provided, against a valuable arbitration claim, a $15 million debt facility that permitted this corporation to continue operating and ultimately access the capital markets because it bolstered its balance sheet. And our return is seen from the underlying arbitration. On a final note, as you consider ways to implement this in your practice, there are many reputable litigation funders out there, but of course you should always do your diligence because not all funders are created equal. And you really want to understand the historical track record and financial capacity of a provider of litigation financing. So as a lawyer, you really should be asking, how much money has this funder made? Across how many and what kind of investments? Over what period of time? How much cash does it have invested in comparable litigation? How much capital does it have available today to invest? What are the sources of those capital? Is the capital legally committed or is it just promised? If it's a hedge fund model, what is the investment period? And what happens if they do not provide capital when capital is desired? As we all know, litigation doesn't always follow your typical path, and a case that you think is going to take 2 years to resolve can often take 7 to 10 years. You want to make sure that if you're entering into a litigation finance transaction, the capital is available when you need it. Not every deal is $2 million provided at close. It could be provided in tranches. It could be provided at different stages in the litigation. So you really want to make sure that when the capital is needed, when your case approaches trial or has additional expert witnesses that need to be hired, that the capital is available so that you can pursue your litigation appropriately. And so you really want to make sure that given the duration of litigation or arbitration, you've identified a funder that has sufficient capital to commit without time constraints, without limitations. So I think this gives a pretty good overview of litigation finance. I hope it's been helpful. And if you have questions, I, of course, have provided my contact information. Thanks very much.
Thank you, Ms. Lieber, and thank you for attending today's presentation. A quick word about Lexby. We were founded in 2006. For more than 11 years now, firms and corporations have relied on Lexby to bring their e-discovery services in-house. We provide an end-to-end, full-featured, and massively scalable cloud-based e-discovery solution. Boutique firms and small to medium-sized businesses have chosen Lexby for our fast and affordable e-discovery software and service. I will ask one quick final polling question. Would you like a demonstration of the Lexby platform? While you answer that, I want to thank everybody for attending today's webinar. After this webinar, we'll be making available a recorded streaming version, an MP3 podcast, and a PDF of the slide deck. If you have any questions or would like a follow-up consultation or demonstration of the software and how it could help you manage the complex and document-intensive cases that you face, please contact me. You can see my contact information on the screen. With that, thank you again, everybody, for attending, and please stick around after the webinar. There's a very brief survey, and we greatly appreciate your feedback. Thank you.